When I started investing in the stock market, I didn't know which option was best for me. Should I throw my money into dividend stocks to earn some passive income? Or should I let my stocks grow over time with growth stocks? Or should I do a bit of both? In this video, I'll be taking a closer look at both of these types of stocks, comparing their pros and cons, discussing which one might be right for you, and discussing my own personal strategy. So let's get started with dividend stocks. In short, dividend stocks are stocks that pay out a portion of a company's profits to shareholders in the form of dividends. These dividends can provide a steady stream of income for investors, making them a good option for those who are looking for a more stable long-term investment. Dividend stocks tend to have different payment schedules. Some are weekly, monthly, and the most popular ones are quarterly. For instance, last year, Apple paid out in February, May, August, and November. On the other hand, a stock like Realty Income Corporation, or ticker symbol O, pays out a dividend monthly. On top of just regular stocks, which are individual companies, there are also things called ETFs, or exchange-traded funds. These ETFs contain a bunch of different securities, including stocks, which then pay out dividends. So, for example, there is a new but very popular ETF called JP Morgan Equity Premium Income ETF, or ticker symbol JEPI. You can see from the dividend details that its yield is currently at 8.05%, which is pretty high, and I consider anything paying dividends above 5% to be relatively risky. Looking over here, we can see all the dividend payments, including how much it paid out and how often it pays out every single month. For the average investor that just wants to generate income without having to do anything, dividend stocks and ETFs are the way to go. It's as easy as buy, hold, and get paid. And just to give you an idea of what that looks like, you can go ahead and check out my public.com account where I am personally invested in JEPI and several other monthly paying dividend stocks and ETFs. I typically post my dividend payments and I track my progress along the way. With JEPI, you can see how many shares I own here, and you can also see how much I have received in dividend income this past month. Now that we've talked about dividend stocks, let's talk about growth stocks. Growth stocks are stocks of companies that are expected to grow in price faster than the overall market. These companies may or may not pay a dividend, but if they do pay a dividend, it is a lot smaller than what you would see with a regular dividend paying stock. The whole point of this is for the company to take all that money that they have made and to reinvest it back into the company so that they can continue its growth. A good example of this would be Starbucks. As you can see on the chart, it has definitely appreciated in price over the years, but it also pays dividends to its shareholders. On the other hand, Amazon is strictly a growth stock and does not pay any dividends, but it is definitely reflected in its current price. Imagine buying it when it was super cheap and then selling it now. Now that we've discussed the main differences between these two different types of stocks, let's talk about their pros and cons. As we discussed before, one of the main advantages of dividend stocks is that they can provide a steady stream of income for investors, especially those looking to make passive income, or those nearing retirement and who are looking for a more stable investment. Dividend stocks also tend to be a lot less volatile than growth stocks, since they're often associated with companies that have been around a lot longer and have a history of steady earnings. On the other hand, some disadvantages of dividend stocks are: number one, they lack price appreciation compared to growth stocks. Number two, you need to invest a lot of money to generate enough passive income to live off of. For example, let's say that you came across the monthly paying closed-end fund PIMCO Dynamic Income Fund, ticker symbol PDI. It is currently trading around $18.25 and pays 22 cents per share each month. If you were to generate $5,000 a month, that would be $5,000 divided by the payout per share, which is 22 cents, which gives you 22,727 shares. Multiply the number of shares by the price of each share at $18.25, and that gives you a total amount of $414,772.72 invested to get that $5,000 a month. It's not bad when you compare it to how much you would have to invest into a company like Apple, for instance, where you would be in the millions invested. But you also need to be careful because some of these companies have been known to cut or eliminate their dividend altogether. So it's best not to put all of your eggs in one basket. Instead, it's better to diversify into multiple stocks and ETFs, so if something does happen, it doesn't completely destroy your portfolio. Now, moving on, let's talk about the pros and cons of growth stocks. One of the main advantages of growth stocks is that they have the ability to grow in price over a certain amount of time. Therefore, they can provide higher returns in the long run. Because these are companies that are expected to grow at a faster pace than the overall market, investors who hold on to their growth stocks for a longer period of time may benefit more than someone who held it in the short term. However, there are disadvantages for holding growth stocks, one being that they are more volatile in price than dividend stocks. This means that there's a higher level of uncertainty when it comes to the performance of growth stocks, and they may not be the best investment for investors looking for a more stable investment. One of the major issues is that investors are hoping for the stock to go up in price over time, but that may not always be the case. In addition, the only way to get anything from purely growth stocks is to eventually sell them. Now that we've covered the pros and cons of each, let's discuss which one is right for you. Ultimately, the best choice for you will depend on your financial goals, your risk tolerance, and overall investment strategy. If you're looking for a more stable, long-term investment that provides a steady stream of income, dividend stocks may be a good option for you. On the other hand, if you don't need the money right now and you're willing to take on more risk in exchange for potentially higher returns, then growth stocks may be a better option. Or even buying an ETF that gives both, like Vanguard's S&P 500 Index Fund ETF, ticker symbol VOO. Although it isn't a monthly paying ETF, VOO is considered one of the best ETFs since it invests in some of the largest companies in the United States, therefore giving it stability, credibility, dividend payments, and growth. But overall, if you're unsure where to start or what to do, the best thing that you can do is speak to a financial advisor. Now let's talk about my own personal strategy. What I plan on doing and what I have been doing over this period of time is investing in monthly paying dividend stocks. Because as a real estate agent, I don't know when my next paycheck is going to be. So the dividends that I receive from these stocks have actually helped me when I'm in a bind to either pay some bills or even grab some food when I'm on the road and I'm going to go meet a client. But the times that I don't need that money, I just simply reinvest those dividends into more dividend paying stocks and grow my account that way. Eventually, it would be nice to make enough in dividend income where it can pay all of my bills and monthly expenses, so I don't have to worry about those things anymore. But if I had a regular, steady 9-to-5 job, then I would be investing mostly in growth stocks or an ETF like VOO, because over time, those stocks and ETFs could be worth way more than what I put into them now. Then when I'm ready to retire or just cash out in general, I could take that money, put it into dividend stocks to live off of. Overall, everyone has their own strategies, styles, and ways that they invest that the way they do. So always sit down and come up with a game plan that fits your needs before putting your money into any investments. Anyways, guys, I hope this video helped you to understand the differences between these two types of stocks and to make an informed decision about which one is right for you. Also, if you're interested in my stock investing adventure, go ahead and check out the playlist on my channel. It's for public.com, which is the stock brokerage. And I started this account back in May 2021. And so far I have grown it now to over $5,000. A majority of the stocks and ETFs that I hold are monthly dividend paying. So that means that I get to grow my account a little bit faster. So if that's interesting to you, go check that out. And also, if this video helped you guys out in any way, I would really appreciate it if you hit the like button. If you haven't already done so, please subscribe. And if you have any questions, go ahead and leave them in the comment section below. And on that note, I will see you all in the next video.